Today we are covering the fundamentals of capital gains and losses, a topic guaranteed to appear on your exam. The first step is correctly identifying a capital asset. The exam will test this by asking you to distinguish it from other property types. Remember, almost everything you own for personal use or investment is a capital asset, like your home, car, stocks, and bonds. The critical exam trap is knowing what is not a capital asset. This includes inventory, accounts receivable, and most importantly, depreciable property used in a trade or business, which falls under Section 1231. For instance, a question might describe a delivery van used by a flower shop. That van is a Section 1231 asset, not a capital asset. The desk you are sitting at in your home is a capital asset, but the desk in your office used for your business is not. Next, you must master the holding period. This determines whether a gain or loss is short-term or long-term, which dictates the tax rate. A short-term gain is on an asset held for 1 year or less. A long-term gain requires a holding period of more than 1 year. The exam loves to test the boundary. If a taxpayer buys a stock on May 10, 2024, and sells it on May 10, 2025, that is a holding period of exactly 1 year, making the gain short-term. To be long-term, it must be sold on May 11, 2025 or later. Here is a phrase to lock this in. More than a year is crystal clear. If it's not more than a year, it's short-term. Short-term gains are taxed at ordinary income rates, while long-term gains receive preferential tax treatment. Reporting these transactions involves 2 key forms. Form 8949 is where you list the details of each individual asset sale, separating them into short-term and long-term categories. Think of Form 8949 as the detailed logbook. The totals from this form are then carried over to Schedule D, which is the summary sheet. On Schedule D, you net your short-term gains and losses against each other, and your long-term gains and losses against each other. The final net capital gain or loss is then calculated, which flows to Form 1040. An exam question might give you a list of transactions and ask for the net long-term capital gain, requiring you to properly categorize and sum them from what would conceptually be on Form 8949. For the 2025 tax year, long-term capital gains are taxed at 0%, 15%, or 20%, depending on the taxpayer's taxable income. While you likely won't have to memorize the exact income brackets, you must know that these favorable rates exist only for long-term gains. But be aware of exam traps involving special types of assets. The gain on collectibles, such as art, antiques, or precious metals held for more than a year, is taxed at a maximum rate of 28%. So if a question describes the sale of a painting held for 5 years, the gain is not subject to the 0, 15, or 20% rates. It's subject to the 28% collectibles rate. Another special category is unrecaptured Section 1250 gain. This applies to the gain on depreciable real property. Like an apartment building, that is attributable to depreciation previously taken. This portion of the gain is taxed at a maximum rate of 25%. The exam will test your ability to recognize these special rates and apply them instead of the standard long-term capital gain rates.